Right now, the global risk-free rate is holding firm at 4.59%, leaving a risk premium of less than 15 basis points for Singapore property trusts. For anyone relying on these distributions to fund retirement, this tiny margin means your monthly cash flow is exposed to massive structural friction. Today, we trace the hidden capital trail from the Gulf liquidity squeeze directly to your retirement account to see if your portfolio will survive. A fixed income trader friend with 2 decades in the market sent me a link at 11 at night with no message attached. Most financial content is built around excitement, what is surging, what is breaking out, what you might be missing. I am deliberately building something different. Retirement-grade investing is not exciting. It is disciplined, forensic, and it is designed to still be working when you need it most. Let's look closely at the hidden chain the market is currently failing to price in, tracking the money all the way from the Strait of Hormuz down to your supplementary retirement scheme account. The data that made me sit up was the sharp advance in the United States 10-year Treasury yield through 4.59%. At the exact same time, foreign central banks have been quietly reducing their Treasury absorption pace. This is happening right when Washington needs to issue a massive $2 trillion in new debt this year alone. The critical reality is simple. The list of willing international buyers is getting shorter, which means yields must stay elevated to attract international capital. Before we break down the mechanics, we have to acknowledge that the playbook looks completely different depending on where you are standing right now. For a 45-year-old investor still in the wealth-building phase, this macro shift is uncomfortable but ultimately manageable. You have the time horizon to reposition. But if you are 58 or older and actively drawing down distributions to live in a 4-room flat in Toa Payoh or Bedok, this is not abstract financial theory. This is your immediate monthly cash flow at risk. That demands a disciplined and forensic approach to capital preservation. Let's begin with the core of the global supply shock. On the 28th of February 2026, the US-Israeli air war against Iran effectively closed the Strait of Hormuz. This single maritime waterway previously handled about 20 million barrels of oil per day, 20% of all seaborne petroleum trade and global liquefied natural gas volumes. Physical disruptions of this scale follow a specific historical logic. Think of the severe energy shocks of 1973 and 1979. Where initial geographic blockades quickly translated into systemic monetary crises. The scale of this supply deficit is something the global energy infrastructure simply cannot absorb. Gulf production shut-ins reached 7.5 million barrels per day by March 2026 and expanded to 9.1 million barrels per day by April. Alternative pipeline capacity across the region maxes out at only 3.5 to 5.5 million barrels per day. That leaves a severe structural deficit, and it presents a direct threat to your central provident fund and supplementary retirement scheme capital. This structural energy shortfall has triggered intense inflationary pressure across global markets. Brent crude averaged $103 per barrel in March 2026, with the Energy Information Administration forecasting a cyclical peak of $115 in the second quarter. The United States Consumer Price Index for April accelerated to 3.8%, its highest level since May 2023. That was driven by a 17.87% spike in the domestic energy component, pushing gasoline and diesel prices to extreme highs and cementing inflation as a permanent fixture in fixed income markets. Here is the gap between the consensus narrative and forensic reality. The general consensus assumes that asset-rich petrostates benefit uniformly from high crude prices, leaving their sovereign wealth funds flush with capital. The data tells a completely different story. Kuwait and the United Arab Emirates were forced to curtail physical production from early March because their onshore storage facilities hit maximum capacity. The result was acute US dollar liquidity shortfalls despite their massive paper wealth. High crude prices on paper did not translate into spendable dollars. This capital strain culminated in mid-April 2026 when the United Arab Emirates Central Bank governor traveled to Washington and quietly requested an emergency dollar swap line from United States Treasury and Federal Reserve officials. This echoes the emergency liquidity operations of past global financial crises. A physical trade disruption instantly fractured the balance sheets at the very core of the global dollar system. And here's what most retail investors are missing. They focus entirely on the face value of sovereign wealth assets while ignoring the structural dollar shortfalls. When a sovereign state holding $2 trillion secretly petitions Washington for a currency swap line, the global liquidity narrative is fundamentally broken. These are not relief measures. They are defensive walls built to prevent the forced liquidation of United States sovereign debt. The safety margins for interest-sensitive assets are rapidly evaporating. Now let's map out how a dollar shortfall in the Gulf transmits directly to a household balance sheet in bulk. The first visible pressure point is your local retail utility costs. Global energy inputs feed directly into electricity tariffs and transport overheads. In the second quarter of 2026, Singapore electricity tariffs rose 2.1% quarter on quarter. That is a direct, immediate squeeze on daily operational expenses across the heartland. The far more destructive damage occurs within your long-term retirement savings. The benchmark sanctuary for Singaporean savers is the Central Provident Fund Special Account, which pays a guaranteed 4.0% with zero market risk. To justify moving capital out of that sanctuary into equity structures like Singapore Real Estate Investment Trusts, you need to clear a minimum hurdle rate of 4.7% to secure an acceptable risk premium. With global yields rising, that traditional yield spread has compressed below 15 basis points. That drags investors into a highly dangerous compression zone. The structural equilibrium that previously supported income portfolios is broken. As the United States 10-year Treasury benchmark advances, the yield premium on real estate investment trusts evaporates. The only mathematical way to restore an acceptable risk premium is for underlying asset valuations to price downward. At the same time, access to cheap debt dries up, placing massive downward pressure on distribution per unit metrics as corporate borrowing costs re-rate higher. To understand why this hasn't triggered an immediate collapse, look at a unique divergence in domestic monetary policy. The Monetary Authority of Singapore manages inflation through the Singapore dollar nominal effective exchange rate currency band rather than through domestic borrowing costs. Because of this framework, Singapore short-term rates do not always move in lockstep with global rates. This creates a temporary structural insulation for short-term domestic borrowing instruments, one that decouples them from global correlations. This policy decoupling has created an extraordinary yield divergence signal in our local market. The Singapore 6-month Treasury bill is currently yielding just 1.40% in the secondary market. That is well below our 3.2% forensic floor and far below the guaranteed 4.0% paid by the special account sanctuary. Meanwhile, the United States 10-year Treasury sits at 4.59%, actively compressing equity risk premiums on a global scale. That demands a forensic investigation into our capital markets. Many retail investors are falling into a dangerous refinancing delusion. They evaluate the safety of a property trust purely by looking at high occupancy rates and portfolio scale. The reality is that even a premium property fully leased to top-tier tenants cannot protect your income stream if the underlying mortgage debt reprices upward by 200 basis points. Free cash flow will be aggressively diverted to satisfy bank covenants long before any physical vacancy appears. Your survival rule must be to identify fortified balance sheets that have zero immediate need for market refinancing. Let's lay out the raw evidence from the macro dashboard. The United States 10-year Treasury yield has advanced to 4.59%, up from 3.5% 3 years ago, compressing global equity risk premiums. Foreign central bank treasury holdings sit at $9.49 trillion, creating forced liquidation risks if deficits widen. Annual debt issuance in the United States has climbed to $2.06 trillion, meaning yields must stay elevated to attract capital. Locally, the 6-month Treasury bill has dropped to 1.40%, signaling extreme domestic liquidity concentration. And on the energy front, Kuwait daily oil exports have hit 0 barrels from a baseline of 2.5 million, placing their $66.1 billion in United States treasuries at immediate liquidation risk. That is the full picture in one frame. Everything in this macro environment anchors back to one critical number, 4.59%. The United States 10-year Treasury yield is the global risk-free foundation against which all yielding equity structures are priced. When this benchmark advances by 50 basis points, it applies immediate downward pressure on asset valuations across the globe because investors naturally demand a much higher yield premium to compensate for equity volatility. For anyone managing retirement capital within a supplementary retirement scheme account, the math is unforgiving. If your real estate investment trust delivers a nominal 4.7% yield matching the historical hurdle, your true risk premium over the global risk-free rate has shrunk to less than 15 basis points. Holding full equity market volatility for a 0.15% premium makes no sense when you can access a guaranteed 4.0% with zero market risk inside the Central Provident Fund sanctuary. We must accept that this is a permanent structural shift. Washington is now forced to issue $166 billion in new bonds every single month. They must sell this volume continuously to fund deficits. With fewer willing global buyers on the horizon, sovereign treasury yields must remain structurally elevated, removing the cheap money foundation that propped up the last decade. Turning to the local strategic landscape, Singapore banking institutions like DBS, UOB, and OCBC remain highly resilient but are actively transitioning as net interest margins decline. DBS net interest margin down 23 basis points, OCBC down 28 basis points year on year, though strong wealth management fee income is temporarily offsetting the squeeze. Real estate investment trusts like SSR face widening refinancing spreads and single market concentration risks. Telecom giants like Singtel offer subscription cash flow insulation but fail hardgate yield floors. Singapore Airlines remains on a neutral watch list, positive interest on cash holdings, but active net profit compression. Let's map the macro scenario matrix across three pathways. The high probability base case assumes the strait remains closed through 2026, keeping crude between $100 and $115 and the United States 10-year yield near 4.59%. Real estate trust distributions will contract as interest hedges expire. The low probability bull case looks for a rapid diplomatic resolution before the end of the second quarter, moderating crude to $80. The moderate probability bear case warns of a multi-theater escalation, pushing crude past $130 and treasury yields past 5.25%, triggering widespread capital flight and covenant breaches. Before we outline the tactical playbook, every retail investor must run a rigorous three-step forensic stress test. First, the debt maturity check. What percentage of your real estate trust debt matures within the next 18 months? Can net property income sustain distributions if replacement financing clears 5%? Second, the organic cash flow check. Are your dividends from industrial blue chips funded by core operations or by asset liquidations? Third, the Central Provident Fund optimization check. Have you maximized your exposure to the guaranteed 4.0% special account rate, the only risk-free instrument currently clearing our yield hurdle? For my elite investors, I have already uploaded a complete interactive spreadsheet matching these three parameters so you can stress test your holdings instantly. If you want zero-day access to our automated debt wall tracking tools and zone-by-zone sector breakdowns, join Iggy's elite investors using the link in the description below. Moving into the operational playbook, my personal sanctuary threshold remains firm at 3.2%. A severe macro shock does not change this floor. It simply reduces the number of assets that can successfully clear it. Your interest coverage ratio safety floor must remain comfortably above 4 times. Any vehicle carrying gearing trending toward the 35% ceiling faces immediate structural pressure. Free cash flow will be silently redirected to satisfy bank covenants long before any physical vacancy materializes. For the accumulator aged 50 to 57, still actively working and drawing a salary, the current macro configuration demands an immediate asset transition. Chasing high-yielding leverage equities right now introduces uncompensated capital risk directly into your retirement foundation. Optimize your guaranteed capital bases, abandon the assumption that equity risk premiums will naturally return to the low-rate averages of the previous decade. If you are a drawdown investor aged 58 to 65 who is retired or semi-retired, securing cash flow stability must take absolute priority over speculative capital growth. Aggressively avoid engineered yields. Trusts that exhibit a consistent decline in net asset value expose your core retirement capital to permanent impairment. Your immediate focus must be a strict reallocation toward assets maintaining an interest coverage ratio comfortably above the 4 times safety floor. This brings us to the urgent structural question that every independent investor across our mature estates must answer today. Is your monthly retirement income stream genuinely built on the organic rental cash flows of a fortress balance sheet? Or are you holding a yield trap whose underlying value is quietly declining, leaving you exposed to severe margin compression the exact month your domestic utility bills increase? Before I deliver the final verdict, I want to note something. You are here because you demand the forensic truth before committing a single dollar of your hard-earned capital. The YouTube algorithm doesn't know that you read every line of data or check the corporate gearing ratios twice. It only tracks one automated signal, whether you have clicked that subscribe button. Every forensic investor who gathers data without subscribing remains entirely invisible to the machine. If this data-driven analysis has helped you identify a hidden risk or accurately calculate a true margin of safety for your retirement account, take 2 seconds to subscribe for free and share this breakdown with one person who needs to hear it. This isn't for my benefit. It is to collectively signal to the platform algorithm that rigorous data-driven local market analysis deserves a permanent seat at the table alongside the noise. As we enter the closing analysis, remember that the ultimate resolution of an international liquidity crisis is never determined by the initial geopolitical trigger. It is entirely determined by the secondary capital pathways constructed by central banks to manage the dollar shortfall. The activation of emergency currency swap lines confirms that global monetary authorities are prioritizing sovereign funding stability over equity market valuations. That removes the structural safety net that historically supported leverage yield instruments during global slowdowns. The true impact of this international transmission chain is measured by its human cost across our heartland. Consider a retired 62-year-old former logistics supervisor in Jurong East who relies entirely on local commercial trusts to fund his monthly healthcare and groceries. As global refinancing costs rise, his nominal distributions compress, forcing a direct reduction in discretionary household purchasing power. While corporate cash flows are silently redirecting to service international bank debt without a visible stock market collapse. To ensure your capital strategy can structurally survive higher global risk-free rates, you can access the full macro evidence dashboard and complete data tables on Substack. Our zone-by-zone sector positioning and debt wall tracking timelines are updated continuously. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The red flags were always there. Our 7-day early access window ensures you can review the full balance sheet tracking metrics and debt wall timelines before public release. If you are serious about managing a retirement portfolio in this macro environment, lead time matters. Secure your access through the link in the description below. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.